our Lord 2025. I'm Jim Munchback, and we're ready for an early lecture. So we're getting started a little early today, but I want to get started with tax allocation. I want to get this one kind of in the can once I finish this live stream. We should be live now on YouTube, Facebook, LinkedIn, X, where else? Did I say LinkedIn? Yes, LinkedIn, my favorite social media platform. So if you're in our summer session of personal finance at the University of Houston, Bauer College of Business, this lecture is for you. This would normally be uh, assignment 11. We're going to talk about tax advantaged investing, otherwise known as tax allocation. So we've got a lot to cover. I'm going to get started so that I can finish early and then go and do some work on grading. So hope you had a great 4th of July Independence Day celebration. I was in Lansing, Michigan, visiting my mother, and that was awesome. Just got back, and now I'm trying to catch up. So here we go. I'm going to try to jump in and, okay, there we go. I'm having a little technical difficulty, probably because I'm working out of my RV here at Lake Livingston State Park. So, hey there, we'll see if we can get everything to work. I think it's working, but it's a little delayed when I push these buttons. I have a studio in Friendswood, and everything works better there in Friendswood. But right here, I'm working with a couple of different tools, and sometimes they delay. So if that happens, I'll try to get it fixed. I'm also using a wireless mic, kind of a new Hollyland thing. So do leave a comment if you would. How's the audio? So like I said, I'm going to get started early today so that we can get this one posted to the playlist. Uh, got a lot to cover. Not so much in terms of the lecture. Today's lecture is pretty easy, pretty straightforward, and we'll get it knocked out. But this is summer school, and I want to mention before we get started that we've got several students who are behind, having trouble getting their assignments in on time. And because of that, if you look at the syllabus, you'll see how late assignments are handled. And so this semester, summer school is challenging. Like I've been saying from the beginning, summer school is very challenging because we compress the entire semester into a very short number of weeks. So this week, we only have one assignment. We've been doing 2 assignments each week. So hopefully that'll give you a chance to catch up. And several of you, I have been sending messages, just it's a handful. The majority of you are doing a great job, and I appreciate that. I appreciate the A students who do A student work, but as I've said before, I was never an A student in college. I was a solid C student. And so if you're one of those like me who works full time and struggles to keep up with your deadlines, please take advantage of the early assignments, get some extra points, get a chance to let me give you some feedback so you can correct those errors, and then you'll still get the extra 10 points. That's a 20% bump. I've been begging you guys to take advantage of that all semester, and now a handful of you have been late multiple times. You're way behind, and for those of you, and you know who you are, I want you to think about dropping the course and taking it again in the fall when you have a little more time to keep up. I don't know what else to say except I'm sorry it didn't work out, and let's try it again. Next semester will be my last semester to teach before I take a 1-year sabbatical. So this is my last summer session to teach before my last fall session. So anyway, I'm sorry to be the hard guy, but it is summer school and it is challenging, and you chose summer school. So Best of luck. I hope you can pull it through. You need 950 points to get an A. So, you know, you have 200 points for the capstone assignment, which is coming up. But this week's assignment is tax allocation. So let's get started. By the way, you will see that in the link or in the description for the video below, you'll see a link to this post. So this post, Tax Advantage Investing Review, is for you. And you'll see there in this post, I've put in a couple of videos if you want to watch their previous lectures for this topic. So for summer school, that's probably not a bad idea to watch those. If you're watching on YouTube, one of the things I love about YouTube is you can watch at 2 times the speed. And I promise you, you can listen faster than I can talk. So let's see. It looks like I am not where I thought I was. See if I can get, so I am sitting here showing you this post, but it wasn't, you weren't seeing it. Sorry about that. So this is the post. Again, in the description of the video, whether you're watching on LinkedIn or YouTube or Facebook or X, whatever, there's a link to this post. So this is the post you'll want to look at. And again, these are the videos that I've posted in previous semesters. I like to talk about the 3 buckets. I don't have the buckets with me today because I am, again, away from my regular location. I'm sitting here in my RV. This is kind of like a little office in our RV at Lake Livingston State Park. So it is a little tight, and I don't have my buckets here, but these are the buckets, and I'll just mention them pretty quickly. In fact, I think this will be the secret class collaboration comment. So the secret class collaboration comment is going to be these 3 buckets. And I'm going to mention them pretty quickly. And the reason I'm going to mention them so that you can just say, hey, the 3 buckets are, in the first bucket, there's actually 4 buckets. So you can say that, 4 buckets. That big blue bucket in the back, that's a tax, that's a taxable account, okay? Big plastic blue bucket, taxable account. You're going to need to set one of those up in your, you're going to set one of those up in your right capital plan this week. So the big blue bucket just represents any type of account that you have at a brokerage. And so that's one of the buckets. And these are just props that I use when I teach this. So I'm just mentioning them before we get into the lecture. You will read about them in Money Study Group. But the big blue bucket is nothing special. It's a taxable account. And when you invest in a taxable account, you always pay tax on your gains. So if you buy a stock or an ETF or a mutual fund and then you decide to sell it, any gains, you are immediately in that tax year, you have to pay the tax on those gains. That's why it's called a taxable bucket. That big brown bucket, I should have some better pictures. The big brown bucket, and if you watch the video, you'll see the buckets are right there because I hold them and they're props. But anyway, that next bucket, the big brown bucket, that's your 401k. We talked about that last time we were together. So the 401k is a tax deferred account. It's a large metal brown bucket. Okay, so just be thinking, again, these are props to help you remember the types of accounts that we're going to talk about. And then the next larger bucket, the one with all the cute decoration, that's an IRA. So when you have a 401k, if you leave your employer and you move on, you can roll over your 401k into an IRA. So that's, excuse me, that's what that bucket is. And then the small gold bucket is the tax-free Roth IRA. So these are the types of accounts you're going to learn about in this lecture, in this week's lesson. The taxable account, which is nothing special. It's taxable because when you trade, when you invest in a taxable account, you pay tax on all of your earnings immediately. When you invest in a 401k, that's a tax deferred account. It's a wonderful thing. I talked to you about the perfect investment, and that is the 401k. When you leave your employer and move on to another position with another company, you will generally roll over the funds that you have in your 401k into an individual retirement account. Technically, IRA stands for individual retirement arrangement, but most of us just think of an individual retirement account. It's a tax deferred bucket, and it's very similar to the 401k, except it's not as big. But it can be very big because you roll over those funds from your 401k into your IRA account. Now, when I say 401k in this big brown bucket, let's say you work for a nonprofit or you work for the government. Well, that's going to be a different type of, it's going to be the same type of account, but it's going to have a different number because it's going to show up in a different paragraph in the tax code. So that's the thing with all of these. They're all a chapter or a chapter in the IRS code. So those are the buckets. There's 4 of them. The big blue bucket, taxable. The big brown bucket, 401k. The next big metal bucket is the IRA, and the beautiful gold bucket is the tax-free Roth IRA. And if you want to know what that pink shovel represents, stick around to the end. And if I have enough time, I will give you that. So let's get started. I'm going to go to, hopefully this works. It looks like it's going to work. Let's get started. Let me get rid of that. So we're going to just take a look at the different types of accounts I already mentioned. The 401k type of account. Let me get rid of that so we have a little bit more room. Okay, I'm pushing my buttons and nothing's happening. So give me just a second. There we go. I pushed the button. My buttons are working occasionally, occasionally not. So we'll talk about these. The 401k, oh, my button's not working again. You know what? I hate it when that happens, but it's part of the deal. Talking points. So I'll show you what's happening. I'm pushing this button right here, and it's supposed to take that from there to there, but it's not happening. I don't know why. Let's see if this works. Show. So I may just have to go like that. So that's what I'm going to do. Sorry about that. Okay, so first thing is the 401k. So there it is. My button's not working. I apologize for that. None of my buttons, well, there we go. The 401k is the tax deferred. And you learned about that last week, so you should be familiar with that this week. Now, this week you're going to have a quiz, and you're also going to have to set up these accounts in Right Capital. So I'll show you how to do that in a minute. But these are just some of the things we're going to go over quickly today. The 401k plan is the tax deferred plan. The Roth IRA is the tax free. That's the only tax free investment I know of. So I want you to know about the Roth IRA. It's a wonderful type of account for you to put money in. And like I said, you're going to have a quiz. You're going to have to learn about how these accounts work. And so one thing I want you to know about is tax penalties. When you put money into a retirement account, you can't take it out early. 59 and a half is as early as you can take it out without penalty and without paying tax. So you'll want to know how that works. Also, each of these different types of plans have different eligibility rules. You don't have to become an expert at that. I just want you to be aware that you have to be eligible for the plan. So for example, for a Roth IRA, you have to have earned income. So that's an eligibility requirement. You have to have earned income. Now, just FYI, my wife Connie doesn't have earned income, but she qualifies to contribute to a Roth IRA because of my income. So that's just a little inside baseball, but that is, oh, I just figured out I was pushing the wrong button. So there we go. So the Roth IRA, tax-free, tax penalties, plan eligibility. One thing I want to mention quickly is tax allocation. When we go into, let me jump into, I want to jump into Billy's plan real quick. If the buttons work, it's a button working. Come on. There we go. So you see I am now here. I'm going to jump into Billy's plan profile. I just want you to see, for example, Billy has all these different types of, all these different accounts. Let me get that out of the way. Gosh, I apologize. I think I need to restart my Mac to get these things out of the way. Sorry about that. So this is Billy's account. I told you before, Billy's account is kind of a Frankenstein account, his right capital, because I use it for demonstrating demonstrations. But anyway, you'll see like Billy has a taxable account, and I just want to show you quickly how to set those up, because you're going to need to do this in your account and your right capital. You're going to set up an investment account, and you see it's got taxable. It's got all those different types of accounts listed right there. So when you set up, you're going to set up 3 different accounts in Right Capital. One is going to be this taxable account. Remember the big blue bucket? So that's the taxable account. And then you're going to do the 401k. And again, that could be a 403b if you work for a nonprofit. But anyway, that's your big brown bucket. And you're going to need to set that up. And then there's also, you'll see the Roth IRA or rollover or Roth rollover IRA. But either way, that's what you're going to want to set up in your account. You're going to want all 3 of those accounts. And remember, because you're 10 years older, because in this semester in Right Capital, we made you 10 years older, so that here's where the 10 years older comes into play. Because you're 10 years older, what I want you to do is a little research to figure out how much money would you have been contributing to your 401k. And so for 10 years, so when you add this account, you're going to have to come up with a balance. And this is going to help you learn how asset allocation works. So the things that you learned last week about asset allocation, you're going to put into practice this week as you set up these 3 different accounts: the taxable account, the 401k account, and then the Roth IRA, the tax-free account. So follow me here. You're going to have all 3 of those accounts set up in your Right Capital. And because you're 10 years older, you're going to have to think, okay, I contributed for 10 years into these accounts, and I had a certain type of asset allocation. Maybe you were aggressive. Maybe you were super conservative. If you're super conservative, then your growth is small. But if you're like me and a lot of folks who understand that long-term investing in a more aggressive way allows you to grow your money a lot more. If you're more aggressive and you've been investing for 10 years using the 4 investment strategies that I taught you last time we were together, then if you're doing those, if you're more aggressively investing, you have more aggressive tax allocation, or asset allocation rather, then you're going to have a lot more growth. So look at that. I've got my accounts there. That's not good. Billy's monster Frankenstein account. So once you set up those 3 types of accounts, the taxable, the 401k, and the tax-free Roth IRA, in your right capital plan, you're going to have a new kind of allocation, and it's called tax allocation. So it's part of the assignment for this week is for you to set those accounts up. My hope is you're going to learn some things about asset allocation as you get to play with those in your account. So you'll get to see how that works, and it's pretty well lined out in the instructions for Canvas in Canvas. So do the reading, do the quiz, all in money study group, and then go and play around with your right capital account. And I'll show you that again. So let's see, I'm going to jump into the next, here we go. And here we go. So the next, let me see if hopefully this is working. Let me get rid of the ticker. Yeah, we'll get rid of the ticker. Let me get rid of that. Okay, there we go. All right, let's see. I want to go to the next. There we go. Types of accounts. Let's go to types of accounts. I think I can get to, yeah, these are the buckets I already talked about. The big blue bucket is the taxable account, which isn't showing here, but the 401k tax deferred account, that's the big brown bucket. And the, let's see if I can get there. Here we go with my buttons again. So the 401k plan, that's the big brown bucket. The blue bucket's not on here, but the IRA, the 401k, that's your employer plan. And when you leave the employer, or when you terminate, go to a different job, typically you roll that over into an IRA. Another option is, and more company plans are offering Roth IRA, Roth 401k, Roth. It's similar. That's a pretty new thing, by the way, the 401k Roth. The Roth IRA has been around since 1998, January of 1998. And I've been taking advantage of that ever since it became available, but they keep improving it. And one of the big improvements is they've added the 401k Roth. So you're not, again, I don't expect you to be an expert in types of accounts. I just want you to understand these different types of accounts, especially the major ones. And the Roth IRA is a major one. I want you to understand that there are taxes and penalties if you take the money out early. So again, you don't have to be an expert, just pay attention and understand that. When you're talking about a taxable account, you pay tax when you have growth, but when you start to invest in these tax advantaged accounts, that's the difference between the big blue bucket and all the other buckets. The big blue bucket is a taxable account. It's not a tax advantaged account. And that's the key thing. And so when you start to invest in these tax advantaged accounts, there are taxes and penalties that come into play. And I just want you to know that there are rules, boundaries, and limitations as you get into that. So some of the plan eligibility rules, let me see if I can get to that. Okay. There we go. Maybe not. All right. Types of accounts. I think I may be, well, maybe that's it. Hold on. Yeah, this is not working. My bullets are not working. That makes me sad. Just know this, again, part of the rules, boundaries, and limitations. You have income limits for contributions. Imagine in a Roth IRA, for example, it's a tax-free type of account. It's awesome. And so whenever you get benefits from the IRS, there's always limitations. So you can only put in so much money every year, not every year, but pretty regularly, they increase the contribution limit. So that's part of your homework assignment this week, is just to understand what are the limitations for how much you can contribute to these types of accounts. Also, age requirements, like obviously you can't be 10 years old and contribute to, you have to be a certain age. Um, and employment status, if you're going to invest or have an account, a 401k account, you have to be employed. I already mentioned spousal contributions. For the Roth IRA, my wife doesn't have income, but she gets to contribute because of my income. So those are just a bunch of different rules that I just want you to be somewhat familiar with. Um, let's see what's next. Uh, hmm. Okay, Roth IRA tax-free. Let's see if I can get you've got some homework assignment to get familiar with the eligibility rules for a Roth IRA. And again, contribution limits, tax advantages. The main tax advantage is that when you contribute to a Roth IRA, you've already paid tax on the money. So now you're contributing post-tax funds into the Roth IRA. And when that money grows over time and you take it out at age 59 and a half or older, you pay no taxes on the growth. That's a fantastic benefit, and I want you to be aware of it, and I want you to understand how it works. Again, there are withdrawal rules. Uh, you can't take funds out of a Roth IRA without paying taxes on the growth, and there's some rules about that and some exceptions as well. Again, penalty exceptions. So those are some of the things you'll be tested on in your quiz. And same with 401k. This is a little bit out of order. We've already talked about your contribution limits. Last week, when we talked about the perfect investment, we talked about the employer contributions, which if you have a matching 401k, which hopefully you do, then you get your contribution and it gets matched up to a certain percentage by your employer. So that's a big benefit. And tax benefits are, again, when you contribute to a 401k, it's tax deferred, but you get a tax deduction for everything you contribute. So you get to deduct what you contribute to your 401k from your taxes, which means you pay lower taxes. And the growth potential is fantastic because over time, as you're making trades or you're using those investment strategies that I taught you, the 4 investment strategies, beginning with diversification, asset allocation, dollar cost averaging, and portfolio rebalancing. So imagine if you rebalance your portfolio, what you're doing is you're selling some holdings that have grown to buy some that have gone down. So when you rebalance your portfolio, that's like making trades. And if you did that in a blue bucket, in a taxable account, you would have to pay tax on each of those transactions. If you sold, remember Farmer Joe's cows, if you sold some of those cows because the price was high and you bought chickens because chickens were basically on sale, well, you had to pay tax. If you're in a taxable account, you have to pay tax when you rebalance that portfolio. But that's not true in a 401k or, for that matter, in a Roth IRA. So that's one of the big growth potential, one of the reasons you have such an extraordinary growth potential in these tax advantaged accounts. And I want you to understand that. Again, withdrawal guidelines, you can't just take the money out anytime you want. If you're 59 and a half, you can take the money out. But if you're in a 401k or one of those tax deductible IRA accounts, when you take the money out, you will pay tax on the income. Okay, so if you take out $50,000 when you're 60 years old, it's as if you gave yourself a $50,000 income. Okay, so that's how that works. The idea is that when you're making more money and you're contributing to your 401k because you're making more money, that tax deduction is more valuable. Once you stop earning a high income when you're retired and you start earning less and you take money out of your 401k, the idea is you're going to be in a lower tax bracket. So that's the idea. That's how tax advantaged investing works. So that is that. Let me see again. Okay, here we go. So here's some of the penalties. Some of the penalties are, let me see if I can get this. I've got so many buttons. If they worked, it would be awesome, but it's not working at the moment. So here we go with tax penalties. Hopefully you already understand that early withdrawal, you're going to get a penalty. I have so many, over the years, I've had so many clients who needed money and they took money out of their 401k as a loan. And what happens is when you take money out of your 401k, because let's say you get behind, this one person that I recently helped had some they had taxes due. They're like me, they have a business. And when you're a business owner, you're supposed to pay the estimated tax on a quarterly basis, your income taxes, because if you have your own company, you know, you're not getting your taxes deducted from your paycheck. So if you have your own company, you're responsible for putting money aside and including making sure that you send money to the IRS every quarter. And if you don't do that, you get charged a penalty in your taxes when you do your taxes. So the IRS is, they're tough. They want their money. So this person who I serve as a client had not done that, had not put money into their taxes. So they needed to pay their taxes. And to do that, they took some money out of their 401k, which just compounded the penalties. It gave them more income that they had to pay more taxes on, and they had to pay a penalty, a 10% penalty for taking money out of their 401k before they were 59 and a half. So I think it's the worst possible financial decision you can make next to getting divorced. Getting divorced is very brutal financially, not to mention it's really hard on your family. But anyway, for financial choices, as far as bad financial decisions go, taking money out of your 401k early is a really bad idea. So, because you pay taxes and you pay penalties, so you don't want to do that. Let's see if I can get this to, yeah, early withdrawal penalties. There are some exceptions to the penalties depending on the type of account. Again, you don't have to be an expert on that. I just want to mention it. Another thing I want to do, I do want to mention, you probably don't care. Most of you probably don't care. But as you get older, you will care about what's called RMDs, required minimum distributions. So minimum distribution requirements means, and the way we say that in the business is RMDs, required minimum distributions. And what happens is you have certain, when you have an IRA, and that's generally what happens, you have a 401k that you're putting money into and your employer is matching it. But then at some point when you retire, you roll that into an IRA. So you could have this big IRA, individual retirement account, could be worth, hopefully it will be worth millions by the time you retire. Well, the IRS says you have to take some money out of that. You have minimum required distributions. And so it's important just to know that that's part of the deal. So one of the benefits of a Roth IRA, a tax-free Roth IRA account, is that there are no minimum distribution requirements, no RMDs. And that's another reason, another benefit of the Roth IRA, the tax-free. It's just got lots of benefits, and that's one of them. So that is, button's not working again. So anyway, tax implications, lots of tax implications. And I would encourage you to plan to avoid the penalties. And one way you can do that is by having an emergency fund. I hope by now we've convinced you. I hope you've realized that having an emergency fund, having a solid amount of money that's set aside for emergencies is a really good idea, because it can prevent you from making some really bad decisions in your lifetime. Let's see, what else do we have? I'm going to see if I can. I think I've covered. Let me talk about 401k for just a minute. Uh, the 401k is the perfect investment. And so as you do your homework this week, as you build your right capital plan, I'm going to jump in there real quick and show you again, just talk about your homework assignment as it relates to right capital. But I want you to, if there's one thing that I hope for you from this semester, one big takeaway for what you learn this semester, it is to be very confident when you sign up for your 401k. On day one, when you get that job, your dream job, on day one, you're going to have to do a lot of paperwork with HR. And part of that paperwork is setting up your benefits. Your benefits, your 401k is one of those benefits. So one thing I want you to be able to do as a result of taking this course is to feel very confident about getting your 401k set up. So the first thing is just to know that yes, you're going to participate in the 401k. Number two is you're going to have to you're going to be asked, how much do you want to contribute to your 401k? So hopefully by now you have thought through a little bit about how much will you contribute. And that's one reason your right capital plan and the capstone assignment that's coming up is important for you, because it gives you an opportunity to say, okay, I'm going to pretend that I'm making this much money. You were supposed to do some research and figure out how much would you earn if you got your dream job. And if you earned that much, let's say it's $100,000, and you're earning $100,000 because you got your dream job. How much are you going to save in a 401k? And my hope is that you've already thought about the fact that your company match is, let's say, 8%. That would be a great company match. But let's say that your company is matching 8% and you're making $100,000. We did this math earlier in the semester, but I'm hoping you can think through this and make this decision on day one when you get this job. So if you make 100,000 and the company matches 8%, what that means is, in order for you to receive the company match, you have to contribute $8,000 to your 401k. So that's a pretty easy calculation. I know I'm keeping the numbers simple, but that's what I want you to know. That's what I want you to think about. That's what I want you to be very confident about, is how much. Yes, I'm going to contribute to my 401k. Two, how much? Oh, that's a no-brainer. I got that. If it's an 8% match, you're making 100 grand, you're going to contribute 8 grand at least, because you don't want to miss out on that contribution. That means at the end of the day, or at the end of the year, you will have $16,000 in your 401k. That's amazing. That's great. That's what you want. So that's what I hope you will take away from this semester. And in addition to that, you've got to decide what are you going to invest in. And that's where asset allocation comes into play. and those strategies that I taught you, that's how you're going to maximize your returns and minimize your risk. But the type of account, the 401k, the way you start that is just say, yes, I'm going to do that. And two, how much am I going to put into that account? And then number three in your 401k is what are you going to invest in? And that is asset allocation. So with that, let me take us to Billy's plan if I can. Let me get rid of, well, let's see. Again, the button is not working. Well, usually if I go like this, there we go. I think I need to reboot my Mac. That usually helps. So here we have Billy's plan. So if we go to his 401k, you'll see here, and you'll see this too for yourself. When you set up your 401k, remember, I'm asking you to be 10 years older, which means you've had 10 years of contributing to your 401k. So you did a little research to figure out uh, how much are you going to be making, and what kind of 401k does that company offer. And hopefully you've come out with some numbers that make sense. That's how I'm going to grade your capstone assignment, is do these numbers make sense based on your research? And that's not difficult to do, so hopefully you've done that. But anyway, here's a total balance. So this is Billy. He's been investing for a while, and this is his 401k. So you're going to have the same type of account because you're going to set it up this week. But then we have the asset allocation. Now this is where you get to decide, how do you want your asset allocation. If we go preservation, now that growth is going to be a lot less than if we go most aggressive. And you'll see there how that, excuse me, how that changes in each of those asset classes. Now, I know when we talk about investing, there's a lot of information to learn and absorb. But when we talk about asset allocation, remember, in terms of the 4 investment strategies that I taught you, asset allocation is the single most important determinant of your portfolio's returns or results. And so asset allocation is hugely important. And this week I want you to think about, how are you going to allocate the assets, the investments inside of your 401k? Remember, types of accounts, it's just a type of account. You put money into that account. But the investing in that account, that's when you choose actual investments. And so I want you to be comfortable when you start that job on day one. Yes, you're going to do a 401k. 2, you're going to know how much you're going to contribute to your 401k, because you're going to invest, you're going to contribute at least as much as you need to get the full company match. So that's how much you're going to invest, how much you're going to contribute, I should say. But then you have to decide, how much are you going to invest in each specific asset class. And don't worry about it now, but when you get to that point, you're going to have some options. Every 401k has a little bit different options. So you're going to look at your options and you're going to pick the best one, but you're going to have a good idea. And this is what's going to give you a good idea. You may not have mid caps. You will have large growth, I promise you that, or large value. You should have small cap. You should have some emerging markets and bonds. So you see, if you just look at this screen, and you'll have it in your right capital plan. Just look at that, and that's a great list of asset classes. And as we talked about when I told you about Farmer Joe investing in cows, just remember, each of these asset classes responds differently to different markets. So when the market is the way it is now, we're at all-time highs, large growth, large value, they're doing great. Small caps doing pretty good. Bonds are doing pretty bad because interest rates are up high. When interest rates go down, bonds do really well. So you should be thinking about having a small percentage of bonds, even though you're an aggressive investor. Because again, when you rebalance your portfolio and you sell off some of those large growth stocks that are so high right now, you're going to sell them off while they're high and buy something that has depressed. Well, this is how you do that. So I'm just showing you that this is how you do your asset allocation, and you get to choose from the list right there. It's super easy. And when you do that, when you create your accounts, your taxable big blue bucket account, your 401k big brown bucket account, and your Roth IRA, your tax-free golden bucket account, each of those you have to decide what is your asset allocation going to be in each of those. And over 10 years, contributing to those, you're going to see the ending value of your plan based on that. So now what I just did is I clicked on retirement for Billy. And again, this is a Frankenstein plan. So you can see at the end of his plan, he's going to have $39 million, which is a lot. You're going to find, and remember, this is really important. If you have more than $5 million at the end of your plan, you need to make a comment and tell me, why is that? So in this case, Billy's account, he's putting a lot of money away. He's got a lot of accounts there. You saw that. If we go to profile, that's where you'll go, profile, and you'll see all of these investments, and he's got $3 million already invested, and he's paying off his debt as quick as he can. So that's why, and he's a young guy, and when we go to retirement, we have a pretty good number there. And you may have the same thing. Now this is, we don't have to get into this today, but I want you just to see these action items. This is the retirement analysis screen. And this is where I do the majority of my work when I'm working with clients and reviewing. So I want you to know that this is here. If you're one of those students who's curious and you like the idea of just playing around with projections, this is where you would do that. So this is where I've made some changes, adjustments, and some different scenarios for Billy. Anytime you make a change there, make sure you hit refresh. So you can see here that we've got a monthly expense. You can change those in your plan. When do you want to retire? If I change Billy's retirement, I'm going to just move that to age 80 and hit refresh. Watch what happens to his probability of success when I hit refresh. Look at that. So we just added $10 million because we had Billy working longer. It works the same in your plan. These are just different assumptions that you can play with in your plan. But remember, what we're really looking at is your asset allocation. And you can see here under the same retirement analysis screen, you see here that we have a certain assumption for asset allocation across the board for Billy's portfolios. So you can make your change there if you want, and it will change all three of those accounts. So you could go, let's say, conservative, and if we did that, that would, if we hit refresh, that is going to change. Look at that number. It just dropped $30 million. Now, again, this is a Frankenstein plan. There's a lot of numbers that are getting tweaked every time I do this. And your plan may be a Frankenstein plan too. Hopefully not. Hopefully you haven't done as many changes and strange things in your plan in Right Capital as I've done with Billy's plan. But I just want you to see how that works. That's the thing I want you to play with and think about this week. In addition to types of accounts, this is an important piece of your capstone is your asset allocation. So you can just play with that there and watch and see what that does so that you can have some, informed comments about your plan. Because if you have more than $5 million there and you don't tell me, oh yeah, it's because of I'm contributing this much and I have aggressive asset allocation, just pay attention. Like, the worst thing you can do for yourself is when you do your capstone assignment, you have some number there that's in the billions and you don't even mention it. You will get at least a 50-point deduction. So don't forget that. Let's see, one thing I wanted to talk about before I leave, before we end. Um, oh yeah, I know what it was. I'm going to go to dashboard. And you should have the same thing on your dashboard. Just, it's like a summary of your plan. It's a helpful little thingy. Uh, and what I'm looking for is this section right here, and it should be in your plan. So remember, I'm going to leave you with this. Uh, you have the taxable asset. That's the big blue button. And remember, this week's secret class collaboration conversation is tell me about those buckets. You got four of them. The big blue bucket, that's taxable. That's what this is. And then you've got the tax deferred asset. That's your 401k, or it could be your IRA. If you're older, typically you've rolled over your 401k into an IRA. That's the tax deferred asset. Okay, so you're going to have a 401k in your plan. And you're going to have a good number there because we're going to assume, because you're 10 years older, you've been working for 10 years, okay? But this section, the tax allocation summary, it's telling you where your assets are. Some call it asset location. I call it asset tax allocation because it shows us where your money is with respect to tax advantaged or non-tax advantaged, taxable, tax deferred, tax free. So the tax free is the Roth, the tax deferred is the 401k or the IRA, the tax deferred IRA. And then the taxable is that big blue bucket. So again, that's your homework this week. When you finish your homework this week, you should have three types of accounts in your right capital plan, and you get to choose your asset allocation, what makes sense for you, and look and watch and see how those numbers affect your retirement analysis. So I'm just a reminder, the top tabs, if you go all the way to the left, you've got dashboard. All the way to the right, you've got profile. That's where you add the accounts. And then right in the middle, I guess, is the retirement analysis, which is, again, that is the section of your plan I think that is the most useful, because you can do the most things there if you click on action items. Just play around with that. That's what I'm hoping you'll do. And remember, asset allocation is a really big determinant of your results, just like asset allocation is the number in terms of strategies that are designed to help you maximize returns and minimize risk as an investor. Tax allocation is the single most important determinant of your portfolio's returns. So I hope you will pay attention to that. Let me just take a look at the market. Market's down a little bit. Let's see. Tesla's up. So I'm looking at these just because this is crazy. Netflix is crazy. It's finally pulling back just a little bit. Let's see how is Nvidia. Nvidia is such a rock star. Ooh, look at that. ExxonMobil is up. I like that. SPY, that's if I had to invest in one thing in my entire portfolio, it would be, I would invest in SPY. SPY is an exchange traded fund, and that means, well, it trades like a stock. It's not a mutual fund. Fees are very low, very tax efficient, and this is a 3-month chart. So the reason I'm showing you this chart or any other chart. I'll show you another chart quick. So this is large cap. Okay, if you say I'm going to invest 25% of my portfolio in large cap stocks, this is what you're investing in. This ETF, this exchange traded fund, is like investing in all 500 of those 500 large US stocks. S&P 500 means the 500 largest US companies. So if you invest in the S&P 500, one way to do that is this ETF. It's called SPY, and this is its chart. So if you look at that, you'll see that it's way up there, like all-time highs. It's doing great, but I expect it's going to pull back. And so today, well, it would be a good time, I think, if you were going to rebalance your portfolio, to sell a little bit of this off, and then you might want to buy some bonds, because look at the bonds. We're in the middle of an auction, a treasury auction right now. And so bonds, the rates are up. That means the value of the bonds are down. So be a good time to buy more bonds, in my opinion. If I were rebalancing my portfolio, though, which is the fourth investment strategy designed to help you maximize returns and minimize risk, if you click the button in your 401k and said, I want to rebalance my portfolio, what would happen is you would sell off some of those large cap stocks because they've grown to be so much more than 25% of your portfolio. So let's say they've grown to be 40% of your portfolio. When you hit the rebalance button, it's going to sell off a bunch of those. And let's say that bonds are supposed to be 25% of your portfolio, but because it's shrunk, especially in relation to the large cap, the bonds have gotten down to, let's say, 18%. When you click that button to rebalance your portfolio, you're going to be buying some bonds, which is a good thing. That's what portfolio rebalancing does. It allows you to take advantage of the ups and downs in the market. And it's just another way of practicing the dollar cost averaging, which, like I told you before, is, in my opinion, the most powerful investment strategy for younger people, especially if you have a more aggressive asset allocation, because you're dollar cost averaging each. In a systematic way, you're buying a little bit of each of these asset classes. And so when they have movement, you get a better bang for your buck. So the four investment strategies, hopefully you'll remember those: diversification, asset allocation. By the way, diversification, if you go back and just review the Enron story, okay? When you work for a company, you do not want to put all of your investment, all of your eggs in one basket, even if it's your company, especially if it's your company. I mean, especially if it's the company you work for and that's where you get your paycheck. Diversification says, don't do that. Spread it around. That's simple. It's the easiest, most basic investment strategy there is, diversification. Number two was asset allocation, which is the most important determinant of your portfolio's returns. That's why you're going to play with that again this week. Asset allocation. Number three, what I think is the most powerful investment strategy designed to help you maximize returns and minimize risk: dollar cost averaging. Go back and watch the story of Farmer Joe buying cows. The cows go down, he gets to buy more. He's investing $100 a month, and the price of cows keeps going down, but he keeps getting more cows for the same money. And then when cows get back up to their all-time high, he sells some cows, which is portfolio rebalancing. That's number four. So those are the four investment strategies. Hopefully you will become more and more familiar with those, because you'll be able to practice those inside of your 401k in real life. And I promise you, you'll become an investing guru if you just learn those four investment strategies and you do what I'm teaching you to do in the perfect investment, which is your 401k. So I think I'm going to leave it there as we watch the market go up and down. And I'm going to end and then make sure that this video gets posted into the, we've been going an hour, so it's time to say goodbye. Good luck with your assignment, and I'll be here if you have questions, and I'll be talking to you soon. See you next week with the blueprint for financial success.